Some think this young woman's small tailor shop only works with cloth and thread. Little do they know, something greater is quietly being pieced together.
Thank you. Kongsi. Bye-bye.
Girls, let's pack.
Boss, actually there's another job.
What? How can we finish it in time? Who is it for?
Oh, my best friend.
Boleh je. You go now and enjoy your reunion dinner. Go.
Go. You can come back tomorrow.
Silap-silap kita ni orang yang last kali rushing for Chinese New Year.
At least you got salary and job, ma. No complain, lor.
Less talking. Faster finish this lah. And don't forget, once this is done, we still need a design that can represent all of us, you know. We can make it, right? It's Chinese New Year, you know. This is so heavy and muddy. Why do you always pick the lotus?
I remember when I was a young girl, my mom told me that the lotus is a lot like women. Kaini, Maru, Amay.
Bos, ingat tak masa tu? Ada tak mampu nak bayar rental rumah. Tapi you datang.
Why don't you come work with me?
You showed me how to live with dignity.
I telah cakap berapa kali, kerja biar tak boleh bawa anak, Ma.
You can speak up for yourself.
There was a time I honestly didn't know how to continue living. It was you. You told me everything was going to be all right.
It'll be okay. Come, follow me.
And that has carried me until today.
We made it for you, the lotus. Because it was you who told us that the
Lotus doesn't choose easy water to grow in.
Even when it grows from mud,
It keeps its beauty,
untouched
touched by what tries to hold it down.
It is you that reminded us, no matter how difficult things become, you don't lose who you are.
Thank you, everyone. In the end, the greatest wealth is knowing our true worth.
And that is the story of this young woman's small tailor shop that has been quietly helping hundreds of women piece their lives together again.
Good morning, everyone. Welcome to the Morning Kappa at 8 on Wednesday. I'm Vincent here, and I'm here to present the Midweek Futures Traders Technical Brief. And we are on week number 2 of February 2026. This table provides a landscape of how our traders have been focusing on the overall top volume products that we offer from RHP. And from this week's table, in fact, what is noticeable is that a lot of the products have turned into a neutral position. Foremost, we have looked into the US products and especially the indices, which has been on a neutral landscape, or the setup, on neutral. Even for the Asian markets that we are looking at, Hang Seng, and for the China market, it's also gone into some neutral stance. And as mentioned before, neutral is always a position whereby the markets will prepare itself for some kind of movement, whether up or down. And therefore, we will try and focus on what markets will do in the week ahead. And there will be 2 products which I will be talking about later on. Nikkei, on the other hand, is still positive. And for the agri side, soybean oil and soybean is positive, whereas corn is neutral. But I'll be also sharing some comments on soybean, why it's turned positive and whether this could be sustainable. Metal-wise, we have seen some intense volatility whereby we saw many traders have to manage their positions, including seeing a lot of their stop losses triggered during the volatile period. And as always mentioned, when we are trading markets, we have to always look into the risk side of things and have to weigh on how we can manage the risk and also to protect the portfolio that you have. So this is just a reminder. And for crude oil, also we have got a neutral, and natural gas has turned negative. This is palm oil, and according to the Arab Ministry, palm oil could decline beneath the 4,000 ringgit per ton level by April, as it contends with an influx of South American soya oil in cost-conscious markets such as India. And this is from analyst Dora. So, but on the technical side, we have seen movement on the upside, but a consolidation is now in the progress. We notice from the chart that we are showing here. Moving ahead for Commitment of Traders US indices, as mentioned in the first slide on the table, this is a part whereby we saw the neutral stance trying to look into some kind of a direction from the Commitment of Traders point of view. For S&P 500, there is a reduction of short positions. And for the NASDAQ too, there is also a reduction of short positions. The Dow, on the other hand, which we have seen rising to new highs, buyers have been plowing into long positions over the February 3rd report of the Commitment of Traders, increasing by almost 2,000 lots. So we'll go into the first chart here. This is the S&P 500 chart. So the heading is wrong here, right? Okay, so S&P 500 chart. And basically it shows here that it's been on a neutral stance, you know. And basically why it's like that is because the US markets, there has been a rotation of non-tech sectors such as energy, consumer staples, the materials and industrials. We have currently outpaced the gains of three sectors dominated by mega cap tech stocks. And this has been the pattern since the beginning of the year. So again, the heading is wrong here, right? Okay, it's supposed to be the S&P 500 micro. The numbers are correct, and we are looking for a positive setup for S&P 500. Current price is at 6982, and the reference price is at 6920, and we're looking at for the S&P 500 to go beyond the 7,000 at 7040, which will give us a US dollar 600 ringgit potential gain. And for potential loss, we're looking at below the 6865, that is a loss potential of 275. And moving ahead to oil and grains, the soybean in particular has seen an increase of short positions. Also corn and for soybean oil, there has been a reduction of shorts by 5K. But for the focus here today, for the next product that we are recommending is the soybean oil, March 2026. As we can see, there is a major spike on the chart, and what this has depicted is very much enthusiasm of traders who were excited about President Trump's calling for China to buy more US exports. But how long this will continue hinges on traders' view that China may not be buying more, and so this remains to be the big questions here. And for the very reason that Brazil, the world top producer and exporter, remains to be significantly cheaper during the peak export season. So Brazil is a competitor to the US producers, and therefore this may be just a knee-jerk that we are looking at here. So for profile-wise, it's a positive for soybean, but we have a short-term setup that is a negative. Current price at 1123, and should the price break below the support of 1085, that means we would be seeing this as the reference price, and the potential profit that we're looking at will be 1065, which will give us a US dollar potential profit, and the loss in case things go wrong would be below the 1105 level. Okay, so that's all I have. I'll pass on to the next speaker. Thank you.
Okay, all right. Morning, everyone. Thank you, Vincent, for the weekly update. So looking at the Hang Seng market, all right, the Hong Kong, Hang Seng has been moving up for the last 2 days, showing that the selling pressure has moderated so far. So we just keep a bullish bias on the Hang Seng index with the stop-loss point at this 26,400 point level. And we can see that yesterday, right, the sentiment remains bullish on the commodity related counters, as well as the oil and gas counters. Meanwhile, we do see the pop mark have been moving up for the past 2 weeks. While the pop mark is moving upwards, you can see that one of the Malaysia stocks that link to pop mark or Lala Boots, the Semico, are also moving up since listing about 1 month ago. Right, and as of the Hong Kong market, right, today we'll be looking at two counter quite interesting. Firstly, UC App Tech, where the share price have break past the 117 Hong Kong dollar. So the next R1 will be 130 and followed by 145. Sorry, I can see that the stock has been consolidating sideways, and looking at the volume profile, right, a very strong support have established at 107. Right, so as long as UC App Tech stay above 107, right, it should continue on the upside movement. And then on another counters, which is the CNOOC, which is also a Hang Seng index member. So this counter is also another commodity stock that most people have been trading in the Hong Kong market. So in China, there are two oil counters very famous. It's called the CNOOC and the 857 Petrol China. Regardless, the oil price moving up, moving down, you can see that this stock has been moving up steadily over the time. So CNOOC have break past 24, right now heading towards 25.50 and followed by 27. Downside support is at 23. So you look at most of the China trading forum or the investment community, they always says that their index being supported by Liang Tongyu, right? Liang Tongyu that's supporting the index of these two barrel of oil, which is CNOOC and 857 Petrol China. So these are the index members that have been supporting the Hang Seng index. So one thing that you look at the Hong Kong market, basically, as we know that right now, mostly the stocks are actually origin from China, and in the China market, government policy is actually very important. Hence, you look at in the Hong Kong market, I would think that technical trading has become very important. So the stock that actually been moving up on the uptrend, that's where you can actually using a breakout strategy to follow on the momentum. Meanwhile, if the stock actually break down, such as the 710 cent, it's become downtrend, and we'll be using a counter trend rebound strategy. So as of now, I think this morning market will be looking at UC App Tech stock code 2387, and then CNOOC stock code 883. Right, and so for yesterday, the Dow Jones continue to stay above the 50,000 point level. Meanwhile, the S&P have amount profit taking. Despite that, you can see that Tesla has bucking the trend, move up yesterday, right? I think one issue among the Magnificent Seven, especially the AI, the tech stocks right now, the market actually worried about their how are they going to fund the AI expansions, as most of the tech stock they have actually laid out a very big capex spending this year. So as for Alphabet and Google, they're actually going plan to sell a 100-year bond, right? And that's why the you can see that the most of the tech stock like Amazon, right, Google, Meta, they actually have been pulled back from their recent high. Meanwhile, as a comparisons, I think Tesla is not in rush for funding. For Tesla, this X AI rumor is going to merge with the the SpaceX company, right? So Tesla itself may not have a funding need so far. So what we do see yesterday night is that Tesla has been hitting the support level, and right now is moving up towards 450. So on the upside, the next R1 will be 450 and followed by the 500 level. Now, as for the FKRI, right, it has a minor pause yesterday, right, due to a profit taking, but overall, the uptrend remains intact with the support level at 1690. We still keep a bullish bias on the FKRI. Hopefully, somewhere next week when we head into the Chinese New Year holiday, right, or after the Chinese New Year on the day 3, day 4, even the following weeks, we shall see. Hopefully, we can see a Chinese New Year rally during that 1-2 weeks period. I think in the past, you look at the seasonality effect, right? I always see that the market start to actually move in a very fast pace, right, during the Chinese New Year holiday break. Okay, so I think as we are moving towards Chinese New Year, this holiday break, don't forget in the morning we go visit our varieties. In the night, continue to look at the market, right? As for the FCPO, right, it has going for corrections, and as what Vincent have mentioned, market sentiments was affected after the remark by Dorab Ministry that is looking at palm oil to drop below 4,000 somewhere before April this year. So yesterday, right, MPOB does release statistics, which our analyst is going to talk about that, but at brief study, right, the number shows that the productions have actually comes off, and then the exports start to actually increase pace, but also inventory numbers start to actually move down, but the market is actually not happy on the January performance. Hence, yesterday there's a selling pressure. It breached the 4,001 level. So once it reached the 4,001, we just switch from bullish to become a bearish bias on the FCPO. At this juncture, we'll have a short position on the FCPO, and then we'll set our stop loss at 4250. Okay. So yesterday, I think the sentiment was impacted, despite that there's a MPOB data yesterday. So another counter that I think market was actually looking at is Gamuda. So Gamuda have actually reached 4 ringgit support level. This is a support level that we have actually shared out some time ago, right? And so the Gamuda, after the strong selling pressure last week, there's not much selling reports coming out to the market, and sentiment has become calmer right now. So since they have formed a support at 4 ringgit, Gamuda potentially to rebound towards 4.40 and followed by 4 ringgit and 70 cents. So on the downside, I think 4 ringgit will be a very important support level for Gamuda. Hopefully that's the interim support that we see right now. And for another trading stock this morning, we'll be looking at Hengyuan Refining Company, break past the 87 cents resistance. Next hour will be 92 and followed by 97. Counter support is 82 cents. Secondly, we have the Southern Score Builder, SSB8, that break past 57 cents. So after the breakout, Southern Score will be testing 61 and followed by 65 cents. Downside support is market at 53 cents. So we have 2 breakout stocks this morning, Hengyuan and followed by Southern Score. So I stop here and pass on to next presenter, Hilmi. Thank you.
Morning, everyone. So today I'll be presenting on behalf of Leland on the plantation sector update. So in 4Q 2025, we expect that we could see a disparity between Malaysia and Indonesian-centric players. Malaysian-centric planters should see 4Q 2025 earnings improve Q-on-Q on strengthening output offset by slightly lower ASPs. This is because Malaysian spot CPO prices reduced 2.7% Q-on-Q, while PK prices fell 3.3% Q-on-Q in 4th quarter 2025. On FFB output, production improved 10.1% Q-on-Q for the Malaysian companies under our coverage, as production hit a peak in October. However, this is a different story for Indonesian-centric planters because we could see a flattish to slightly lower Q-on-Q earnings in 4Q 2025, as lower ASP would be offset by higher output. Malaysian Plantation should see a strong year-on-year earnings growth in FY 2025 due to higher CPO prices, while also at the same time PK prices also climb up around 27%. So increase in both prices coupled with increase in output, which output increased 3.2% year-on-year, should signal higher year-on-year 2025 earnings. We also expect the same thing for Indo Planters due to higher CPO prices and PK prices on top of the higher output. So overall, we expect earnings to be largely in line for 4Q 2025 based on our estimated FFB production levels. Meanwhile, two companies are likely coming in above estimates, which is IOI and JPG, while two may come in below estimates, which is TSH Resources and London Sumatra. So going into 1Q 2026, however, we expect Q-on-Q earnings to moderate on lower prices and lower seasonal output. So for Indonesian Planters with downstream operations, we expect margins to weaken Q-on-Q from a slightly narrower tax differential between upstream and downstream products of $70 per ton, which is down 8% Q-on-Q. However, on year-on-year basis, we expect margins to decrease as the tax differential narrowed by almost 30% year-on-year from $98 USD per ton in 4Q 2024. So as such, Malaysian downstream, we expect Malaysian downstream to see stronger Q-on-Q and year-on-year margins given that the reduced competition coming from Indonesia. For Malaysians' monthly productions, as a result of lower output and higher exports, Malaysia January 2026 inventory levels fell 7.7% month-on-month to 2.815 tons from 3.05 tons in December 2025. So with this, January 2026 annualized stocks usage ratio fell to 14% from 15.5 in December, although it's still significantly above the 15-year historical average of 10%. So going forward, we expect to see levels continue to moderate as output moderates further in first Q, but digesting these high stocks will take some time. For CPO prices, the CPO prices rose 5% in the last few weeks, given that the recent positive news flow coming out from US, which is regarding the biofuel policy, which we expect to finalize in somewhere around March or April. Second, due to more litigious news in Indonesia, and third one is escalating geopolitical risks between US and Canada. So all these three factors has led to CPO and SBO gap widening further to $135 per ton currently, which is higher as compared to before, which was only $120 per ton. So this is likely lead to an increase in buying activities from major importing countries in the near term. So bottom line is we maintain our neutral call with an unchanged CPO price assumptions of 4,250 ringgit per ton and 4,100 ringgit per ton for 2026 and 2027. Our top pick remains, we like Johor Plantation Group, we like Sarawak Oil Palms, IOI Corporations, London Sumatra, SD Guthrie, and First Resources. That's all for me. Thank you.
Thank you, Hilmi. I'll be the last speaker for this morning. Two reports from me. Number one is the Harta Legas latest results review. We are upgrading the stock to a neutral from a sell with a new 85 cents target price, which is DCF based from 82 cents. So in essence, the third quarter FY26 results was a positive surprise. Core earnings came in at 44.1 million, which actually lifted the 9 months number to 68.5 million. And this number exceeds both our and Street's estimates at about 122% and 113%, respectively. So the key deviation here mainly comes from the sharper than expected margin expansion. So Harta Lega recorded 4.4 percentage point EBIT margin expansion Q-on-Q. This is largely driven by a lower OPEX of about 7%, particularly overhead expenses, which actually declined 25% Q-on-Q based on our calculations. But management attributed these gains to new automation deployments, the upgraded lines with better optimized processes, as well as enhanced the digitalization that actually helps with limiting input wastage. Bottom line wise, it also helped by a negative 9.6% effective tax rate, which is essentially a refund. That is supported by the recognition of unabsorbed business losses and the reinvestment allowance from Plant 9. Reinvestment allowances remain available, and we understand that for the next quarter, there will still be some recognition as they continue to roll out lines in Plant 9. Right. ASP wise, Q on Q, it's down 3.4% from USD $20.60. This continued to be pressured by competition as well as the lower raw material costs. We also understand that negotiations with key buyers are ongoing for higher ASPs, though management cautioned that the volumes may soften in April or May, due to price adjustments. Meanwhile, for sales volume, that actually rose 3.2% Q on Q to about 6.2 billion pieces per quarter, with sequential improvements expected in the following quarters. So for Plant 9, the commissioning of that plant is nearly complete. There's only one line remaining that they have to commission, and that will actually leave the active production capacity to about 30 billion pieces for end of FY26, which is by March next month. And the next capacity uplift will come from Plant 3, which has a idle capacity of 4.5 billion pieces currently. And management has also said that for Plant 9, because they are using the latest technologies, they are able to run that plant with half the headcount of the typical older factories. And that additional headcount will be redeployed into Plant 3. Right, so in terms of earnings, we adjust our earnings FY26 to FY28 earnings by upwards of 56%, but down 16% and down 12% for 27 and 28. Right, this actually reflects a lower effective tax rate of 10% for FY26. And also, we revised our FX forecast with the USD MYR rate of 3.852 by end of calendar year 2026. This is in line with our in-house economist forecast. Nevertheless, if we were to assume that for FY27-28, the ASPs and the exchange rate stays the same at third quarter FY26 numbers, that would mean that our earnings actually is increased to 107 million and 112 million, implying a 23 and 25% uplift from our previous forecast. But right now, because of this FX, we are expecting FY27-28 to actually decline, right? So post these changes, our target price actually increased to 85 cents, which implies a 0.65 times price to book at about 1.7 standard deviation below its 3-year mean. In terms of this whole result, whether or not we are going to upgrade the sector, we haven't decided on that yet. But currently, we do view this improvement as unique to Hartalega, because this is mainly driven by internal cost controls and efficiency gains. In the recent briefing, they also highlighted that their latest technology may even surpass Chinese peers. So currently, we now see valuations as fair, with efficiency gains actually materializing and likely sustainable. And that actually helps counterbalance the looming risk arising from its nitrile heavy exposure, which heightens vulnerability to rising competition in the US market from China's offshore capacity. So all in, we are upgrading the stock to a neutral from sell, 85 cents target price. Next here, we do have a company update on UUE Holdings. Basically, we are maintaining our buy call with an unchanged 64 cents target price. Yesterday, they have won 2 new contracts from Singapore. Each contract is worth about 10.9 million Sing dollar, or 33.7 million ringgit. This contract is related to the supply and installation of 400 kilovolts power cables. The principle of the contract is actually SP Power Assets in Singapore, and UUE scope includes the installation of HDPE pipes using the HDD method, as well as provision of materials, tools, equipment, as well as the labor, right? With this new contract, the outstanding order book actually now stands at 576 million. with SP Power asset related projects now making up about 30% of its outstanding contract. Do note that these two, including these two new contract, this is the third largest Singapore package won by UUE, which includes a broader scope of contracts that actually carry slightly lower margins than pure HDD works that they actually do in the past. But this is still margin accretive as the GP margin is still attractive at about 20 to 30%, which is structurally higher than Malaysia due to the tighter technical specifications. But including this latest win, the contract wins actually exceed our FY26 expectations. But we are maintaining our forecast at current juncture because we do believe that the contribution should only begin from FY27 onwards, given the upcoming festive downtime as well as the potential permit approval delays, right? That's it. No changes here to our earnings estimates. We continue to believe that UUE is well positioned to ride on both TNB as well as SP Power assets CapEx upcycle. They look undervalued currently at about 10.4 times FY27 price to earnings PE ratio versus peers trading at closer to 13.6 times average, right? Maintaining buy with an unchanged 64 cents target price. That's all from me, and I believe that's all from us. Happy to see you tomorrow at same time, morning kappa at 8, right? So thank you all.